Hey, everybody. All right, just a quick update on the quick analysis tool here. I made some modifications to it, a little more clean, but it's still very simple. So on the quick analysis here, I've added some instructions. Just add the purchase price, the number of units, the square footage here, the annual revenue that you get from the listing, the broker, the wholesaler, the operating memorandum, etc. And we want to update the market. So essentially anything that's in the yellow highlighted sales here, we want to update. I guess these are beige. We can make them real yellow if we want. Make it easy. And um, the market, again, is the type of market that we are looking at a facility. Is it in a rural market? Is it in a better market? Or is it in a high quality market? It's a little bit subjective, but you get the idea. We've also got some rate improvement. So like how much do we expect to improve the rates in year one, year two, and year three? These are probably standard if we're buying a deal that has below market rents, even if it's higher than 10%. We know that. Let's keep it at 10%. And so in this example, you can see that the net operating income is $32,160 assumption. If we know what the exact number is, we can essentially type that in here if we want, but I'm assuming 33% expense ratio off of the $48,000 annual revenue. On the right-hand side, this $32,000 is going to give us an idea of the value of this facility at its current stabilized value at a 7, 7.5, and 8 cap. We may be working on deals that are in 6.5 caps, but most of them will be in the 7 to 8 cap range. And so what is this value there? Coming down the sheet here, we're going to see like what the value is of the facility based on this net operating income and the market that it operates in. For instance, if I change this to 8, you'll see the value will 0.08. The value will jump up to $402,000 as an example. I'll go back to the 9 cap. And so we also want to protect ourselves with some closing costs and some reserves. So about $10,000 there. So we deduct that out of like what the maybe value of that facility is. And we come in with a potential offer of $346,000. And so said another way, this is the quick analysis tool as a reminder is a quick way for us to determine whether or not we should do full underwriting. This number 346 is close enough to the 370 that there might be a deal here. And so I probably would spend some time digging into this and underwriting it if this was a deal that I liked. If this was, $600,000 and I'm coming in at 346, I'm probably not going to spend my time underwriting this deal unless I wanted to just submit a lowball offer and see what the heck happens, which you could totally do. I also included an offer multiple table down here. This is just a completely separate way of looking at a deal. And essentially what we've seen and what I've heard, and I learned this actually from a very big operator, is one of the ways that they quickly analyze a deal is they look at a deal through the lens of an offer multiple. And it's a multiple of the current monthly revenue. So if the annual monthly revenue was 48 grand, then the monthly revenue divided by 12 is $4,000. They take the $4,000 and they multiply it by 80, 90, and 100 times, and they get this sort of range, which interestingly enough fits directly in line for the most part in the 80 to 90 range here with our potential offer. And the idea here is that generally speaking, if we can purchase a deal within 80 to 100 times monthly revenue that has the opportunity for us to improve income through insurance and fee income and rate management and maybe reduction of expenses, the likelihood of that deal being successful long-term is pretty high. And successful to us would be that we created equity, that we created cash flow. Then on the right-hand side here is a projection that if we were able to get to year 3 and we were able to drive the value 10% in year 1 and then 5% in subsequent years, then we're at a $56,000 of revenue on this particular deal. Assuming a 33% expense ratio, I have the different cap rates that are here, what the value of the facility would be if we were to go to market to sell it. I've assumed 7% closing costs, somewhere about 5-6% for the broker, another 1 to 2% for fees. You could change this to 8% if you wanted to. 7% is a general number. So we want to deduct that from the value and what we paid for the deal originally, which was the 346. And so the equity creation is what we get essentially a check for at the closing table when we disposition this deal. And then just for, for some guidance, like what would we be selling that at a price per foot? Doesn't really mean yet, like that's not a good thing or a bad thing. It's just like, what is it? So it's just a data point for you. So hopefully you like this. I think it's a little cleaner to look at. I might modify this a little bit more, but hopefully this helps. All right. Quick analyze a lot of deals and find ones that the purchase price and your potential offer price are near each other. Find a deal that is within 80 to 100x. The 80 to 100 times the monthly revenue is close to that offer or the purchase price or what your offer price is, and you might have something that's worth and earned your time to go do the full underwriting. All right, see ya.